All right, ISHR students, we are here for another video lecture. Today we're going to be talking about the balance of payments, sometimes called the BOP, and let's go ahead and get right into it. You can kind of see the scales here on the this first slide. What the balance of payments really has to deal with is it's primarily looking at the exports and imports in and out of a country, and looking at whether that country is a net exporter or net importer. And just to kind of give you a little bit of a brief background before we get into it. But that's not the only thing it looks at, but it is kind of the primary thing that most countries are looking at. Anyway, let's go ahead and get into it. Let's look at our learning goals. What do you need to learn by the end of this video lecture? What do you need to know? First, you got to define and outline the role of the balance of payments. You need to know what is it and why do we need to know it? Or why is it relevant for countries? Next, you need to know the difference between a credit and a debit. This is an important distinction, and it's very simple. Next, there are three major subcomponents of the balance of payments. The balance of payments is broken down into the current, the capital, and the financial account. IB wants you to know all of the sort of subcategories or components of each of these different parts of the balance of payments. So you need to know those different subcategories and their components. Finally, you need to know how the accounts, you need to examine how the accounts are interdependent. So these are our major learning goals. So, at the end of this, you can kind of check back and think, do I know all of these things? Did I accomplish my learning goals? Hopefully you did, or we did. All right, let's get into it, people. Balance of payments. I think before we start with kind of getting into it, we got to define it. What is balance of payments? It's a record of transactions between a country and its trading partners during a given period of time. Why don't you pause the video and write this down, because this is a key definition. You definitely want to write this down in your notes. Pause and write. All right, I'm sure you're done writing. Let's get on to it. The thing is, countries calculate, they want to know about the balance of payments because they would like to know about net exports. They would like to know whether they are an exporting or an importing nation. This basically tells countries how much money is flowing in and out of their country from these exports and imports. And most countries would prefer to be an exporting nation. We would like money flowing in to our country, not out. So we'll get into the specifics in a moment, but just kind of think of it this way. When you think about your own wallet, would you like money flowing in or out of it? It's kind of like the same way a country is. They would like money flowing in from the sale of exports instead of lots of purchases of imports. Okay, so let's talk about the major subcategories. There are sort of two components of the balance of payments. The balance of payments has the first major component is called the current account, and it is, it could be a positive or negative value. And we'll kind of break down the different parts of the current account in a minute. The other part of the balance of payments is the capital account and the financial account. And it's important to note that this is called the balance of payments. So when you add up everything in the current account and you get a positive number, in theory, when you add up everything from the capital and the financial account, you should get a negative number, because the balance of payments, in theory, should balance. And we'll talk more about that later. That's kind of why it's called the balance of payments. So let's go ahead and get into each of the major subcategories of these three components: the current, the capital, and the financial. And but before we do that, I guess it's important to distinguish between a credit and a debit. It's very simple. A credit is a monetary inflow, money flowing in. When you look at your bank statement, when money flows into your checking or giro conto, this is called a credit. Your account has been credited with money. So basically, it's whenever money is coming in, it's a credit. Basically, if you were looking at it from an international economics perspective, if you look at, for example, like exports would be an example of something where someone in our country is getting paid for something from somewhere else, from a person somewhere else in the world. So when, Mercedes sells a car to America, right, a good is leaving Germany, going somewhere else, and money is flowing in. This would be a credit. Debit is the opposite. It's monetary outflow. Money is leaving the country. When money flows out, it's a debit. These are things like imports. When you purchase an import from abroad, like when you buy French wine or when you buy a Chinese stereo or television, money is leaving our country and going into another country. And so this would be an example of a debit. So let's go ahead and just make sure that you have learned a little something thus far. Quick knowledge check. I'm going to ask you 3 quick questions. Go ahead and see if you know the answer to these 3 quick questions. Pause the video, quiz yourself. If you got it, great. If you don't, you need to quiz yourself again until you get it because you need to master the material. First question, define the term balance of payments. Next question, what are the 3 components of the balance of payments? And finally, what's an example of a credit? Go ahead and pause the video and try to answer these questions, and unpause when you're ready to continue. Okay, I assume you've answered those questions. Hopefully you got that the balance of payments is a record of transactions between a country and its trading partners during a given period of time. The 3 components of the balance of payments are the current, the capital, and the financial account. And finally, a credit is a monetary inflow, and an example of that would be an export. An export would be a credit in our balance of payments. Okay, now we need to look at the 3 components of the balance of payments: the current, the capital, and the financial account. You need to know the 3 sort of, or actually in this case 4 different components of this account and what comprises this account. So let's define it first. It basically shows all monetary flows. The current account shows all monetary flows arising from exports and imports, transfers of income, and other net transfers. Again, monetary flows arising from exports and imports, transfers of income, and other net transfers, or sometimes called current transfers. So let's go ahead and look at what is the current account in the balance of payments. It's one major part. So the current account has some components. The first component is the balance in what we call visible trade. Visible trade is exports and imports, and what we're talking about is physical goods. In Germany's sort of context, we would be thinking about cars and electronics and cuckoo clocks and chocolate. Those would be our exports. Our imports would be things like Italian wine and British cars and whatever else we're buying from abroad. Those would be imports. Just note that exports, when we sell an export, a good flows out and money flows in, it's a credit. Conversely, imports, a good flows in and money flows out of our country, that's a debit. Generally, countries will, add up the sales of exports and the spending on imports to figure out the balance of trade. They want to know, do we have a trade surplus or trade deficit? And so again, when you add up the value of the exports and the spending on the imports, we can find out how much money in total is flowing in or out of the country. A very useful statistic. The thing is, it's not the only thing in the current account. The current account has actually 4 components. And some of those components, or one of those components, is basically called the balance in invisible trade. And so these are basically other reasons that money is flowing in and out besides exports and imports. The first major one that kind of comes to mind is services. We have service exports and service imports. Service exports, for our purposes, if we were looking at the German context, a service export is something like hotel sales in Germany. If a foreigner comes to Germany and stays in a hotel, that is a service export. Because if you think about it, they come to our country, they spend money here, so money is flowing in to our country. It's a service export. However, when you, as a German or international student, leave this country and go to another country, that would be a service import if you were to stay in a hotel and spend money there. So again, money would be flowing out of our country and into that of another. So that would be what we call invisible trade. But it's not the only invisible trade. We also have income. And basically, income is flowing in and out of a country as well, and is a part of the current account. And basically, money flowing in is receipts, those would be credits, and money flowing out are payments, debits. The first one is investments, and basically, it's money received from holding an asset. Think of it this way. Investment income is basically if you owned a stock in a country or a company in a country that was not your own, right? For example, let's say you own stock in, I don't know, in General Motors in the United States, or let's say Apple in the United States. If you owned Apple stock, when Apple makes profit, they have to give that profit to their shareholders in the form of dividends. And so it doesn't matter where you live or what country you live in, Apple will pay those dividends to their shareholders. So if you, a German, own stock in Apple, and Apple has to pay out those dividends to you, they will basically be sending money from America to Germany, and that would be investment income. So again, that would be a credit in the balance of payments. However, if, for example, if an American had German stock of Mercedes or Siemens or whatever, and Mercedes and Siemens make money and then they have to pay that money out in dividends to their shareholders, money is leaving Germany and flowing to another country. That is a investment outflow or a debit in the in our current account. The next kind of major income transfer in the current account is called remittances. And remittances is basically when money is sent to another country. It's when you remit money, you send money from one country to another. And primarily it's when overseas workers send money to their country of origin. A good example would be in the Philippines. There are a lot of overseas workers in Hong Kong. When they send money from in Hong Kong dollars to their relatives in Manila or wherever, that is a remittance, and for the Philippines, that is a current account credit because money is being sent into the country. And for Hong Kong, it is a debit. Money is flowing out of Hong Kong. So anyway, that is a remittance. The final sort of form, or the final sort of part of the current account is called current transfers. And this, it's sometimes called net transfers, but usually current transfers, and it basically has to do with money flowing out that comes from what we call international quote-unquote gifts. We're looking at grants, subsidies, aid that is sent from one country to another. If you think about it, when Germany sends aid to foreign countries, money is flowing out of Germany and into another country. So that would be a debit in our current account. So, for example, two examples might be the UN gives Afghani women aid for development or a grant, Afghani women in Kabul to sort of promote women's education or promote some sort of development in that country. That would be a current transfer credit for Afghanistan because money is flowing into Afghanistan. Also, countries gift money to one another too, especially in times of need. The United States a few years ago sent money to the Philippines for this horrific typhoon called Haiyan that destroyed a ton of the Philippines, and the United States and a lot of other countries sent money to the Philippines. This would be an example of a current transfer. All right, so that is basically, those are the four main components of the current account. Again, it's exports and imports, invisible trade, which is basically services, income, which is remittances and investment income, and finally, current transfer. So those are the four major components of the current account. When we take those components and we add them together, we come up with the current account balance. So we add the exports, we minus the imports, we look at the money flowing in from remittances, and we look at the money being remitted out of the country. We look at the investment income coming in, and we look at the dividends being sent abroad. We add all of this together, and we come up with a number. When we come up with that number, it is basically the sum of all of the sub-balances within the current account. If we have a positive balance, we call it a current account surplus. And generally what that means is that there is greater export revenue than import expenditure. Now, it doesn't mean that those other elements aren't calculated, but generally the two most significant parts of the current account are exports and imports. And so generally what we can deduce from a current account surplus is that export revenue is greater than import expenditure. Countries would prefer to have a current account surplus because it means that money is flowing in. However, if we add up everything in the current account and it is a negative number, so maybe we have a lot of imports, or we have a lot of people remitting money out of our country. If we have a negative balance, it's called a current account deficit. And basically, it generally means, but not always, that import expenditure is greater than export revenue. But is it possible that it's remittances and maybe service exports and imports could lead to a negative current account balance over exports and imports? It's possible. It's very unlikely. Okay, let's take a look at this in real life. The IMF, the International Monetary Fund, produces data and statistics on the current account balance worldwide. The green color you see is countries with a current account surplus. The red, the darker the red, the worse the deficit, has to do with a current account deficit. Why don't you go ahead and take a look and see if you can come up, identify the nations that have the big current account surplus and deficits, and think about why do they have big current account surpluses and deficits. Go ahead and take a minute and just jot them down. Which ones have the big deficits? Which ones have the big surpluses? And you can pause the video, write this down, and we'll talk about a few of them. Okay, done writing? Great. Well, as you probably can see, the United States has probably the biggest current account deficit, and it is huge. They do export a lot, but the imports are far greater. Where do a lot of those imports come from? Well, from China. China has a huge current account surplus. They sell a lot of goods and services, but mostly goods, to the United States. Japan and Germany do as well. Japan and Germany are also, you can see, countries that have big current account surpluses. And you can probably identify the goods that are sold abroad from Japan and Germany. And they're sold all over the world too. I mean, cars, electronics, all sorts of different goods. Finally, you can also see some other countries that have current account surpluses. You can see that, for example, Saudi Arabia looks to have one. Venezuela does. Iran does. Libya does. What is their big export? Same with Russia. Russia has one too. Well, you probably know that these are all oil exporting countries. And so they have a lot of exports, and that kind of leads them to have a current account surplus. All right, so this is going to be, we're going to stop here for our video lecture. We'll take a break, and this is just on the current account. we're gonna pick up with a second video on the capital and the financial account and the balance of payments. So anyways, I hope this helps, and we'll be uploading the second half of the video lecture in just a minute. Thanks for watching.